Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, June 4th, and we have a lot of moving parts. Yesterday's session, very interesting, a lot of things going on. Overall, if you look at the session in the U.S., at least, we sort of managed to halt the meltdown. If you look at the S&P 500 and closed at a reasonably small loss, but there's a lot going on otherwise. But first of all, let's get to the European session yesterday. I think it was very interesting. We saw the DAX, for example, bouncing from a 200-day moving average. I've got a chart here showing that 200-day moving average, the big red line there. You could argue we're still in a downtrend. We need to see it popping back above about 11,800 to 11,850 to 12,000 there. But as well, we're seeing risk appetite showing up in emerging markets overnight. So we're a very mixed session. But the key development yesterday was the most interesting. The largest companies in the world in the U.S., these big monopoly companies, Facebook, Google, Amazon, and even Microsoft. I've got a chart here showing their price action yesterday. You can see a very ugly session. We're talking about near 10% falls, at least from the previous session all the way to the lowest lows during the inter-session time period yesterday. As the U.S. Justice Department and Federal Trade Commission are moving to investigate these for for monopoly practices and whether the current legislative environment is actually up with the times, if you will. And you can see that the worst of it was received, I would argue, with Facebook and Google. These are, I think, the clearest cut cases for arguing that these are in fact monopolies, and especially in the advertising space. So this is a really key signal. I think it might have even fed into the currency market. We saw the dollar rather offered yesterday, and it makes some sense if people are having to pull out of their investments in these world's largest market cap companies effectively, and you unwind your dollar exposure therefore. So something to track. This is going to be a long process. These official investigations last forever, but a big move there. Now, I'm going to get to you in a second on gold because I think it's really linked to the Treasury market activity, and that's been actually the biggest mover besides, of course, that interesting move yesterday in those big tech companies and monopolies. Prior two sessions was all about almost an incredible avalanche of buying in the U.S. Treasuries. If you can have an avalanche of buying, that is a fall in avalanche in yields. Let's look here at this is the September 3-month Eurodollar contract. So we've moved from pricing in, maybe they'll cut, maybe they won't, to now pricing in effectively 50-50 odds or better that they'll cut twice, or at least 150 basis point chop in September. Some even predicting 10% odds of three rate cuts, through the September meeting. So just an incredible acceleration there. And I think a lot of that, Ola, I think if you look at the gold chart, those two big sessions where we saw this incredible acceleration in the buying is also where we saw the gold really stepping in.
I think so, because looking at how gold has been performing recently, just taking a look at the chart here, we see that we've clearly broken higher now. We've taken out three previous peaks. We have So the market's now really focusing on that February high, but you're absolutely right, John. And before we just talk about that, just take a look on the right there. We're also seeing ETF investors starting to get back in. We've seen drip selling since February. Now yesterday was the biggest jump since December in the ETF holdings, but. Again, it was the change in Fed funds, Fed expectations last week, I think, that did the trick, because we've seen stock market weakness for a while. The dollar's been relatively stable. We've seen yields starting to come down, but that avalanche of bond buying last week and the complete the change in the outlook for rate cuts, that's really what's currently driving gold. So at this stage, looks like we're getting some tailwind back in. I put out an article yesterday on home.saxo just highlighting the fact that silver is trading at almost a record discount to gold, and it has been left behind. So if we see gold continue to higher, there might be some upside potential in silver, because there is almost a near record short position in silver as of last Tuesday. So that's one we keep an eye on as well.
And highly relevant, we have this Fed conference that's starting today through tomorrow. There's a lot of Fed speakers out, including Chairman Powell himself. I think we're going to need some pretty strong confirmation from the Fed that the market is gunning, that it's gunning for these rate cuts, is getting some support in the rhetoric. Otherwise, I think we may have reached a near-term top in the anticipation here. I don't want to make that call. You don't want to step in front of an onrushing train, but it's just been just to point out, it's been an incredible acceleration. We retweeted a couple of things this morning. The SaxoStrats team just talking about how remarkable this turnaround in the Fed expectations has been. And if you look back at 2007, 2008, it is actually has outpaced the turnaround in the Fed from back then. I don't want to draw too many ugly parallels, but there is the risk that that's where we're headed. Now, if we have reached a near-term sort of climax in this U.S. Treasury buying, you could argue that the yen may be nearing a near-term climax as well. I've got a chart here showing the Japanese yen, the trade weighted in red there, and you can see how that's very nicely correlated with effectively long U.S. Treasury yields, and we've seen that incredible drop in yields, and that has coincided one-to-one with a rally in the Japanese yen. If we're looking at technical levels, we're getting to an interesting level here. This was the sort of the lowest daily close, not including those intraday flash crash lows in dollar yen back at the very beginning of this year. So 107.50 area is an interesting one for dollar yen, and I think again the price action in that pair is going to coincide with the U.S. Treasury market. Now, another indicator besides a sort of collapsing term premium or collapsing yields in the U.S. as well, we look at a classic indicator like an industrial metal, copper. It's also suffering and actually getting to some pretty interesting technical levels as well.
Yeah, just take a look at the chart. Yes, we are starting to. You can argue that we have quite an emerging head and shoulder in high grade copper. We're currently testing the bottom, the support line there. So we can use that really as a market gauge for this recession risk because that's really what could hurt copper even more if we see a potential slowdown in demand, just like we've seen in the recent collapse in oil prices. So it's obviously all linked. And right now, where can you go for guidance in terms of recession risk? You're looking for stock markets. You're looking obviously at Fed expectations. So these are probably some of the gauges that we.
Some of the activity surveys. We didn't bring it today, but we had that overlook or that chart showing all the different PMI developments. They're all sort of nearing or on average, we're getting close to 50.
It looks like if we're just still missing a couple of numbers, I think New Zealand and Canada, but we're getting very close to 50 on the global PMI on a GDP weighted average. So that's it does indicate that we have seen quite a significant slowdown in recent months.
And the U.S. ISM manufacturing yesterday disappointing with a reading of 52.1. I think expectations were above 53. Briefly, a couple more things on the Forex front. We have the Aussie out yesterday, or the RBA, I should say, out yesterday. They did cut. That was fully priced. Their statement very, very light on the forward guidance. They're basically taking this incoming data stance. But I think what sticks out is that 2.75% GDP growth forecast for the remainder of this year and for 2020. Looks awfully rosy from my point of view, and will be easy to miss that, I think, going forward here. So that'll be an interesting one. Technically, you can see that the 70 area, that's the red line there, is rather important for Aussie dollar. Pretty heavy positioning, speculative positioning short there, so an interesting test if we're bumping up into that 70 level. And then again, arguably, what is driving euro dollar higher? We have not particularly good data out of Europe. We have ugly data out of the U.S., but we're also looking at ECB meeting this Thursday, and we have near record lows in German bund yields. There's just nothing to really drive a euro rally besides, I would argue, a dollar sell-off, and that could be linked to, again, this investigation announcement on these big, huge cap companies out of the U.S. Some have visited the $1 trillion market cap area. And there could be, certainly from a positioning, I know your latest positioning report showed a pretty strong dollar.
Yeah, you're absolutely right, John.
Dollar long still.
Yeah, and what is happening during phase of risk of you reducing your exposure, and the dollar is quite long. It's the highest since for a couple of years almost, and we did see a small reduction throughout May when the panic set in, and that does indicate as well. And I think you reflect on that yesterday that we haven't really seen that safe haven dollar buying this time around, because the position is already speculative long of the dollar.
I still see a structural risk of dollar liquidity driving a dollar rally. That's in other words, the dollar may not have peaked for the cycle, but I think short term here does look like there could be a risk of a squeeze, especially when you have a new angle on things like this, for example, this sell-off in these big U.S. companies. So that's an interesting angle. Clearly, there's a big rally relative to the recent very, very lackadaisical price action. So we need to sit up and take notice. Next levels are, I would argue, if we look at the chart again here in euro dollar, let's look at 113. That's this first line here, dotted line on the flat line above where we are now. And then we're looking at 114, the prior area, and the 200-day moving average actually comes in a little bit below that. So an interesting test for the dollar over the ECB meeting, and then the ISM. I'll get to the calendar in a minute. Actually, we'll cover that in a minute. Just want to briefly bring up one entirely different market, Ole, and I think it's a very interesting one is the grain market because of this whole crazy U.S. weather situation.
Yeah, as we mentioned recently, right now the most important indicator for the U.S. grain market is the planting progress reports, which are out Monday nights. And the chart here just gives you a look, give you an insight into this. These are the numbers for corn, soybeans, and wheat. And you can see corn, we're desperately behind schedule, and we have basically run out of time. So corn has continues to be supported. Soybeans still got a few weeks left, but also you can see the planting progress there of 39% as of Sunday. That's again well below and at a record slow pace. The bottom chart from Bloomberg is basically also showing some of we're now going from planting to how the emerging crop is faring, and you can see some of the emerging both in corn and soybean well behind the 5-year average. So again, it's just all price supportive, right? What we're seeing right now, and you can also see that if we go to the next slide that the corn is this December contract is toying with 450, and soybeans now is starting to move higher, because the focus now markets priced in is going to be quite bad for corn. Now we're just going to see if the weather continues to be bad in the US, then soybeans planting will be impacted as well, and that's why we're starting now to see soybeans breaking higher this morning.
So this means as well, doesn't it mean at some point, if you get too late on these dates for the corn and soy, you simply are not getting the crop size that you would normally get?
You're going to cash in your insurance instead, and I think that's probably more or less happening in corn. And some of that was planted has to be replanted because it's just been flooded. So we're going to see a reduction in global stock levels. By how much we'll see in the next WASDE report, the World Agricultural Supply and Demand, that's out next week in a week's time. So they should hopefully have some new revision so we can get a closer feel for it.
All right, let's head to our calendar for today. Things getting interesting on the Fed front. I've seen some of the papers that will be presented, or at least the titles. I haven't read all these papers, but they look rather boring. And again, the whole argument is whether the Fed's change of stance and their argument that they want to run the symmetrical inflation regime has any relevance if they don't have the tools to bring about inflation. In other words, if we're going to cut rates back towards zero and even possibly restart QE, if that still doesn't bring inflation, so what if they've changed their stance? Certainly the dramatic turnaround, again, is already here. We're already just pricing, again, 50-50 odds here for at least two cuts for that September FOMC meeting. But back to our calendar, we've got the CPI estimate up today for the Eurozone. I think we're going to see a Draghi that's very much at a loss to add much energy into the situation. The ECB effectively with an empty toolbox. They can do things at the margin like not assessing not assessing the negative rates on the reserves parked at the ECB, etc. But it's a weak beer, if you will. RBA's low out speaking today, and again, the Fed conference opening today with Powell making some remarks. And look out for Australia again overnight. We've got that Q1 GDP. If there's a bad miss there, it starts to look pretty embarrassing going forward for the RBA's growth expectations. ECB meeting up on Thursday. I'm really focused on the ISM non-manufacturing tomorrow out of the U.S. The services sector far more important than manufacturing. And then we have the latest jobs and earnings data on Friday, so we'll be paying attention to that as we're looking at all the last data cycle into that big June FOMC meeting where we get the final sense of where the Fed is guiding policy now that we have such an aggressive market repricing of the Fed forward curve. That's it for today. We'll be back on Thursday. Tomorrow's a holiday, lucky us here in Denmark, and we'll be back on Thursday with the Saxo Bank Morning Call. Thanks for joining.